Thank you very much. Thank you very much, Tony. This has been great, and thank you for organizing this and showing us, how much more productive we can actually be at conferences, how much better use you can make of technology. I think this is amazing. So I'm not sure this is really about innovative investments, but I'll try to make an innovative paper. So what is this about? We start out from the premise that monetary policy is transmitted to the real economy via banks. So this means that the potency of monetary policy depends on bank balance sheets, and as such, monetary policy can affect the quantity of bank lending, but also its quality in a sense of bank risk-taking. Now, more recently, there's been more attention paid to the role of banks' funding costs in the transmission of monetary policy. So the typical bank business model is that they fund themselves, for example, through deposits, and that's indeed what we will focus on here, and they lend out these deposits in the form of loans to firms, for example, right? And as such, their banks engage in maturity transformation from short-term deposits to long-term loans. Now, in Drexel, Sauer vom Schnabel, banks' funding cost matters for the transmission of monetary policy because they show that market power matters for the transmission of monetary policy to deposit rates. In another setting, looking at the introduction of negative monetary policy rates in the euro area, Florian Haider, Glenn Shepins, and a dubious third person show that there is a zero lower bound on retail deposit rates, and therefore banks cannot go below zero when setting these deposit rates, and as such face an adverse shock to their funding cost when the actual monetary policy rate is below zero. Okay, but these are two very specific instances. One hinges on banks' market power and the other on the specificity of negative rates. What we try to achieve in this paper is to get an answer to the question of whether banks' funding structure generally matters for monetary policy transmission. And if it does, can we say something about the importance of imperfect pass-through of monetary policy to banks' funding costs for the effectiveness of monetary policy, for the cross-section of firms and other borrowers, for the cross-section of cities, just think of more aggregate geographical units, and finally, for the structure of the banking sector. In particular, in this paper, we exploit cross-sectional heterogeneity in banks' reliance on so-called regulated deposits in France. Okay, so the grand feature of these of the rates on these regulated deposits is that they are independent of monetary policy. They set and guaranteed for by the government, and they are not set by the banks themselves. Right. So normally, when we look at deposit rates in this literature, one thing we tend to worry about is the endogeneity of banks' deposit rate setting. This is out of the question here. The rates are set by the government, and I'll tell you more about it in a minute. Okay, this in turn yields funding cost gaps that accrue, arise across banks as a function of the funding structure, depending on whether these banks rely on these regulated deposits for funding themselves. We then use these arising funding cost gaps to identify any effects on the reallocation of regulated deposit-dependent banks in terms of their credits across different borrowers, types of loans, and locations. And to achieve this, we have amassed a wide array of administrative data that covers an enormous range of lending activities of French banks. Think not only corporate lending, that's a particular feature. In this literature, normally we look a lot only at corporate lending. We try to capture as many lending activities as possible by French banks. And then we will also engage in a little aggregation exercise to see whether this matters at the city level. All right, so what do we find? We find that when banks incur higher funding costs due to the imperfect pass-through of monetary policy, then these regulated deposit-dependent banks adjust their lending to the real sector. The interesting bit here is that we can show that they can actually sustain at least 30 basis point higher funding costs until monetary policy becomes contractionary. That means that whatever your monetary policy rate is, the bank's funding cost, which is due to these regulated deposits, can be at least 30 basis points higher, but only then banks start contracting lending because they incur higher funding costs. That is huge news for the transmission of monetary policy, depending on whether you're a dove or a hawk, but okay. Second, we also show that regulated deposit-dependent banks react in terms of rebalancing their loan portfolios in reaction to this shock to their funding cost. In particular, we see a reduction in lending to large firms and safe mortgages. Instead, they ramp up their lending to small firms and entrepreneurs. And this we would call greater bank risk taking. We also show that they lend out at longer term maturities now. Then we try to get at aggregate effects at the city level. Why does this matter? It matters to show that these firms that are in relationships to regulated deposit-dependent banks are actually unable to substitute credit across banks. And that is the underlying reason for why we do find aggregate effects. Because if they were able to substitute away from regulated deposit-dependent banks to other banks that may not have higher funding costs, then we shouldn't see anything at the aggregate level, but we do. So this stuff matters at the aggregate level for the firms. And also in terms of the structure of the banking sector, in particular, we show that there is an increase in the bank concentration. Not sure I will get to that, but I said it. Finally, we document real effects for large firms, for which we have balance sheet data, and for which we document that they are exposed to a reduction in credit supply because these regulated deposit-dependent banks that face higher funding costs, they contract their lending to these safe large firms. So it matters indeed for these large firms in terms of their investment. Okay, so let me take a step back, give you a little bit of background on these deposit accounts in France. Yeah, so French households, they channel 950 billion euros into short-term savings accounts, of which 3/4 are stored in so-called regulated deposit accounts. Among these regulated deposit accounts, the Livret A is the poster child account. What does this allow you to do? Well, each individual can store up to 23,000 euros in them and incur favorable tax treatment. As I mentioned before, the grand feature that we're exploiting here is that the rates on these deposits are not set by the banks themselves. They're instead guaranteed and set by the government in a very weird and interesting way, which I hope justifies to you the term sticky, okay? So they can only do this twice per year at predetermined times in February and in August. And in doing so, these deposit rates follow rules that are designed to preserve households' purchasing power, so do not really perfectly capture monetary policy. On top of that, sometimes the central bank doesn't even follow these rules because the government does not follow these rules because the central bank or the government itself can veto you applying the rule to the new rate that has to be set in February and August. Okay. Now, things are a bit more complicated than that. Banks do not get to keep all of these regulated deposits on their balance sheets, okay? In fact, they have to transfer parts of these funds to the Caisse de dépôt et consignation, which is a special fund operated by a state-owned financial institution, okay? Which in turn uses these funds to finance social housing in France, okay? So you can see how this is a whole subsidy scheme run by the French government, right? On the one hand, depositors have a safe haven here, and this is how indeed some households use these accounts. On the other hand, these accounts are used to finance social housing in France. Okay, but this also justifies why banks have to offer these accounts, but they don't get to keep all of these regulated deposits on their balance sheets. So from this characterization, a smell test, if you will, is whether there is a correlation between the reliance on these regulated deposits and median income. Because if you think of it this way, if you're a poor household, what you're going to do? You're going to save everything you have in these accounts, right? Because they pay a higher deposit rate. But if you're a very rich household, what you're going to do? Well, sure, you're going to max out on this account, but then you have plenty of remaining wealth that you will instead invest in, say, the stock market. Right? So this is indeed what we observe here in areas where, on the left-hand side, these are départements. Banks rely a lot on these regulated deposits. Dark blue, we see light red, low median income. Okay, so I mentioned before that we really want you to believe that these are sticky deposit rates. So let me be very concrete by giving you a couple of examples of why they are sticky. Yeah. As I mentioned before, the government sets the rate in February and August, right? But according to this rule that is supposed to preserve households' purchasing power, but they need not go through with it. And indeed, this has given rise to multiple instances of both upward and downward stickiness during the runtime of our sample. So on February 1st, 2012, the rate was kept at 2.25%, although the rule would have implied that it should have gone up to 2.75%. This was followed by 3 instances of downward stickiness. The then Minister of the Economy, Pierre Moscovici, on February 1st, 2013, reduced the rate only to 1.75%, although the rule implied 1.5%. Half a year later, rate was reduced to 1.25% instead of 1%. And the highlight is on February 1st, 2014, the rate was actually kept at 1.25%, despite the recommendation of the Banque de France to lower it to 1%, when the rule actually implied it should go down to 0.75%. This also means that right now in the euro area, where we have negative rates, this is roughly the rate you can get on your Livret A account. Quite a nice yield right there. Yeah. Okay. So what are the implications of banks' funding costs? As I showed you, I hopefully convinced you of, these rates on the regulated deposit accounts are sticky, and banks cannot adjust them in response to changes in monetary policy. Therefore, banks that rely on these regulated deposits, as opposed to, say, other deposits, the interbank market, etc., they can face higher or lower funding costs than banks whose funding cost is more aligned to the monetary policy rate. Now, the best example of that is banks are funded by the interbank market, because the interbank market rate perfectly follows the ECB's monetary policy rate. Okay, so this is the easiest example for you to think of. A bank that's funded by these regulated deposits, okay, they have these sticky deposit rates, as opposed to a bank funded by the interbank market, which just perfectly tracks the monetary policy rate. Alrighty. And this is what the funding cost gap between these two groups looks like. So I hope you don't have a blue-red weakness. If you do, raise a hand. So in red, we have a deposit facility rate, which is the main monetary policy rate set by the European Central Bank, which is, to answer one of William's questions on Slack, the rate that typically transmits first and foremost to the actual deposit rates offered and the interbank market rates. That's why we picked it. And that's why people would call it the main policy rate. That's the one that is transmitted to these deposit markets, interbank funding markets. And in blue, we have the gap between the Livret A rate and the deposit facility rate. So there are 3 things you may notice here. First, the gap is positive. So at least during our sample period, the rate on these regulated deposits exceeds the monetary policy rate set by the ECB. 2, the gap is huge. Third, it varies, and it varies in a way that is independent of monetary policy. If you look at this time period from 2011 to mid-2012, yeah, the gap just, not continually, but it does increase, whereas the ECB's monetary policy in the same time period is both contractionary and expansionary. Okay? All right. Do people find these rates attractive? Yes, and here's a way to show this, and this may also be important to get at one of William's questions, something we can discuss later, namely what the true implications of banks' funding costs are. Indeed, what we see here is that when the gap is large, yeah, there are also more deposit flows, okay? So households do flock to the banks or they deposit more when the funding cost gap is larger. When the Livret A rate exceeds the rate on other deposit accounts, the rate on which is more aligned to the monetary policy rate. Okay, as always in France, a country I deeply love, things are a bit more complicated, yeah? So I just told you about the Livret A, and yes, the Livret A is the poster child regulated deposit account, but it makes for only 1/3 of all regulated deposits, okay? There are 2/3 spread out over other kinds of accounts. You see them in the top panel here. And the rates on these accounts are actually pegged to the Livret A rate. 4 out of 5 accounts have a rate that is at least as high as the Livret A rate. And only one of them, the Compte Épargne Logement, has a rate that is accounts for only 2/3 of the Livret A rate. But they only make for 5% of all regulated deposits. So I believe it's fair to say that in general, the rates of regulated deposits are at least as high as the Livret A rate. Okay. Now, not all of these regulated deposits are actually eligible for funding social housing in France, and therefore not all of them are transferred to the Caisse de dépôt et consignation. The Livret A and 2 other accounts are, right? So the banks do not get to keep all of them, but there are 3 other accounts that banks have to keep on their balance sheet. So we will exploit this transfer rate. And you see that this transfer rate has an index B and T, okay? So it varies across banks and over time in the following way. Up to 2008, which marks the year of the law of the modernization of the economy, there were only 3 banks that could offer these Livret A accounts. Starting January 1st, 2009, all other banks offer them as well. Now, these 2 groups of banks vary drastically in terms of these transfer rates. So if you look at the incumbent banks, they transfer 80% in 2010 of the regulated deposits to the Caisse de dépôt et consignation to finance social housing. Whereas the new banks, they come from below. Now, both groups, they have to converge to a single rate of 60% by 2022. So that's another source variation that we're exploiting. Okay, so with all this in place, what's our empirical strategy? The heart of the analysis will be a typical credit registry analysis that many of you have seen in seminars, and some of you may even be sick of, but here goes nothing. So the analysis is at the firm, bank, county, quarter level, which means we are zooming in on a lending relationship between firm F and bank B's branches in county C in quarter T, okay? And then we're looking at whether a regulated deposit-dependent bank differentially adjusts its lending behavior when the funding cost gap between the Livret A rate and the ECB's monetary policy rate changes. That's all there is. Now, how do we determine this deposit ratio? It's a bit of a misnomer. You should know that this is not the total deposit ratio of the bank. This is truly focusing on the regulated deposits. That's the treatment intensity. Well, to arrive at this, we look at the regulated deposits that are eligible for the transfer and use the information that we actually have on these transfer rates. So you have to multiply it by 1 minus the transfer rate, because that's what is left on the bank's balance sheet, plus the non-eligible regulated deposits that are not transferred away and thus have to stay on the bank's balance sheets. And divide that by the bank's total liabilities, okay? As is usually the case in these settings, we can include firm time fixed effects that capture time varying and observed heterogeneity at the firm level, including but not limited to loan demand. I think many of you have heard me say this many, many times, but I'm never sick of repeating it. Yes, we do realize that we lose some external validity by this, right? And the more I work with euro area data, credit registry data, the more I appreciate the fact that, you know, in some economies, firms tend to have a single bank relationship, and then doing this is really harmful. But there are other economies where banks always have multiple bank relationships, and then including firm time fixed effects is not a problem at all. Our assessment is that France is kind of in between, okay? Now, what else can we do? We cannot include bank time fixed effects because that is the level of identifying variation, but we can control for time varying local factors for bank B's branches in county C, at least if the firm is not located in the same county, right? This is actually likely the case because we are identifying the effect of firms with multiple banking relationships, and these firms indeed do tend to not reside in the same county as the loan granting bank. So that works. And then on top of it, we add additional banking group quarter fixed effects. Okay, so what are the data we're using? I was very excited to get access to these data, and Anne is the mastermind. She really knows them inside out. I learned a whole lot about France through these data. Just to tell you what our main ambition here is, the main ambition is to capture a wide range of bank lending activities. I said this in the introduction. So we start with the credit register, yes, but then we also have a bank county level data set that allows us to look at all loans by borrower types, including non-corporate borrowers. So those data are at a less granular level than a typical credit registry data set, but the bank is at the bank county time level. But at the bank county time level, we see banks lending not only to corporates, but also to entrepreneurs, households for mortgages, etc. And that's beautiful. Second, to arrive at bank's funding structure, we make use of bank-level regulatory data from the French Prudential Authority, the Autorité de contrôle prudentiel et de résolution, which gives us a precise breakdown by types of deposits and depositors. And that is key, right? For the stuff I told you about earlier, you have to be able to compute the fraction of regulated deposits held by households out of the total deposit portfolio of a bank. And these data allow us to do that. And finally, we can bring in firms' balance sheet data for SMEs with sales of at least 750,000 euros. Okay, going forward, I will call these firms large firms. These are, by large firms, I mean firms with balance sheet data, when indeed they are SMEs. I acknowledge that might be a misnomer. Okay. Just very quick, if you compare the regulated deposit ratio to the total deposit ratio, they make for a good third of banks' total deposit funding. Let's get to the average effect on credit supply. So here are the results from the specification I showed you earlier. And what we see in the first two columns, even after including banking group quarter fixed effects, is that regulated deposit-dependent banks reduce their lending if the funding cost gap goes up. Okay? Indeed, when we want to quantify this, when the gap widens by 1 percentage point, moving from the 25th to the 75th percentile of the deposit ratio implies a reduction in lending by 4.2%. That is sizable and within the literature, reasonable. Okay, now let's start the identification game. Huh? What is the first thing you may come up with? Well, maybe there is something about regulated deposit-dependent banks that is just reflective of generally deposit-dependent banks, right? Okay, so let's throw in the total deposit ratio, of which the regulated deposit ratio is a subset, yeah? Interact that with the gap. What happens? Nothing, right? So here, the estimate in the top row tells you that regulated deposit-dependent banks react significantly differently to a funding cost gap increase compared to all other deposit-dependent banks, because one is a subset of the other. And the insignificance of the effect of total deposit ratio by gap tells you that banks funded by all other types of deposits do not react any significantly differently from interbank funded banks, which is basically the omitted category. Okay, related to this, the fourth column, we add, you may believe that maybe regulated deposit-dependent banks may have other bank characteristics that explain the lending behavior. So here, just for the sake of an example, we throw in bank size times gap. We also do this with the equity ratio, just basically other factors that in the Kasia-Stein paper, for example, are believed to drive monetary policy transmission, and they don't matter here. Yeah. The last thing we do is to, instead of looking at a continuous gap, look at the gaps in the top second tercile, and the omitted category would be the third tercile. And what we see is that the effect is all driven by the gap being in the top tercile. Now let me show you here what the range of these gaps is according to the terciles. What you can infer from this is that when you move from the very top of the bottom tercile to the very bottom of the top tercile, which is basically roughly 30 basis points, yeah, then you know that banks start contracting their lending. So this gives you like a lower bound for something you may call the relative reversal rate. The reversal rate refers to a concept introduced by Markus Brunnermeier and Jan Kobi, who, by the way, was in the job market this year. And they argue the reversal rate is the rate below which even expansionary monetary policy may become contractionary. We believe that if monetary policy is transmitted to the real economy via banks, then maybe you would want to link this reverse rate to something on the bank's balance sheet. And banks' funding costs may be a very natural component to look at here. And then you can, against this background, interpret this estimate as saying, yeah, banks can incur funding costs that exceed the monetary policy rate by at least 30 basis points before they start contracting the lending. Okay? So that's our estimate of the so-called relative reversal rate. It's a lower bound for relative reversal rate, so to speak. Okay. All these results are even stronger for the firms with balance sheet data. I'm only saying this because we will be able to estimate real effects only for this subset of firms. Okay, now let's take a look at the reallocation of credit. So far, our results indicate that when the relative funding cost goes up, the net interest margin of banks reliant on regulated deposits goes down, and as such, they lend out less. But normally, to offset this effect, banks also rebalance their loan portfolios. So what about it? What about bank risk-taking? To get at this, we use our data at the bank county level to cover all other types of lending. So now we can say something about regulated deposit-dependent banks lending to large versus small firms, households, entrepreneurs, and even a maturity. Let me just point out the most important things here, because I'm afraid I'm running out of time slowly but surely. The credit contraction I just documented to you, I got 5 on it, okay. The credit contraction I just documented to you is primarily targeted at large firms. Instead, there is more lending to the smallest possible micro firms. Okay, that may be indicative for risk-taking. This is further manifested by the fact that safe mortgage lending is going down, but lending to what I would call risky entrepreneurs goes up. Finally, for the subset of large firms, we have internal credit rating data from the French central bank, the Banque de France. And even within the subset, where we know regulated deposit-dependent banks reduce their lending, we see them lending more to the riskiest firms. Altogether, we believe that this is evidence of bank risk-taking. Let me talk about the aggregate effects. To get at the aggregate effects, we'll move to the city quarter level. In doing this, we pursue a shift share approach. If I had more time, I would go on and on about this. And if there were people here like Paul Goldsmith-Pinkham, we would talk even more. Yeah, this approach is appropriate in some instances, not in all, of course. Why is it appropriate here? Because the results I've shown you so far are only along the intensive margin. These were all intensive margin regressions with firm bank fixed effects, looking at firms in pre-existing relationships with banks. When you take that as given, what you can do to arrive at this aggregate estimate at the city level is just look at the weighted average regulated deposit ratio of the banks that serve as relationship banks to the firms that reside in a zip code. Okay, that's exactly what we do here. What do we find? We find that even at the city level, those with greater exposure to regulated deposit banks, because the firms that reside in these cities rely more on these regulated deposit banks, we see less credit being granted when the funding cost gap goes up. And it affects primarily the large firms, not the small firms, which explains the coefficient, the negative coefficient in the second column. Why is this important? We do not emphasize so much that this is quantitatively the same effect as before, but we continue to find a negative effect, which just goes to show that whatever substitution firms are engaging in terms of substituting credit from regulated deposit banks to getting credit from other banks, they cannot perfectly engage in substitution here, because otherwise we wouldn't observe this. So firms cannot perfectly substitute credit. So this matters at the aggregate level for this reason. Let me skip the bank concentration level and just show you at the firm level, we also have real effects that we would expect for these large firms with bank balance sheet data. Why? Because we've seen that this credit contraction affects primarily these large firms for which we do have bank balance sheet data. On top of that, we see that it cannot substitute credit across banks. And second, these even admitted large firms in the data, they're really just SMEs with no capital market financing, so they really have nowhere else to go. So when you adopt a similar approach at the firm year level, even after including county industry year fixed effects, which is the most granular thing you can have here, that is time varying, we find that firms in relationships with regulated deposit dependent banks, yes, they invest less, which is what the first three columns will tell you, but we do not really find an employment effect, which is something the literature has been looking at since the Gabriel Scholl-Reich QG paper. But hey, let's face it, in the US, hiring and firing is a thing. In Europe, the labor laws would typically inhibit you from just readily firing people. But whenever you see an employment effect as a real effect in European data, it would stem from firms not prolonging temporary labor contracts. But enough with the lecturing on European labor laws. Let me conclude by telling you again that the starting point here was the existence of these regulated deposits that have been wildly successful at attracting savings in France. We used the feature that the rates on these regulated deposits are sticky to show that banks' funding cost matters for the effectiveness and the transmission of monetary policy. In doing so, we presented you evidence that points to an important role of credit supply for distributional consequences of monetary policy, right? Because we saw that affected banks favor more constrained borrowers, the risky ones, and especially low-income areas where savings are indeed held primarily in these regulated deposits. And besides that, our results also speak to the potential spillover effects of the creation of safe assets with stable returns. Why? Because by attracting long-term savings, subsidized funds such as these Livret A accounts, they affect the distribution of liquidity and thus aggregate stability in the banking sector. That's it from me. Thank you very much.